The UK government hates UK investors, and in this video we're going to go through exactly why. We're going to be covering changes to some of the allowances and also this 100k ISA cap which has been chucked around in the news recently. Of course, a bit of a clickbaity title headline, but all the information is going to be useful, I promise, so make sure you carry on watching to know all the changes, and also leave your thoughts in the comments below. It'll be interesting to get some discussion over this going. And before we get started, last thing to say, make sure you subscribe and turn on the notification bell so you don't miss any future videos, all here about investing and personal finance. So what am I talking about? There's two things here mainly of why the UK government potentially, maybe, just about hates investors in the UK, and that is the allowance side of things and then the ISA side of things, which is also actually an allowance. But yeah, let's start with the first one I'm talking about, which is capital gains and dividends. So you probably are aware, if not, this is pretty important information, but as of April going onwards, the CGT, capital gains tax allowance, which is currently 12,300, is getting cut in half, and the dividend allowance, which is currently 2,000, is also getting cut in half. But then the following year, they're going to get cut in half again. So almost in 2 years, there's going to be a much reduced CGT allowance and dividend allowance. So what does this mean? Let's go through the good and the bad. Why it doesn't matter first. Ultimately, if you're investing in the stock market, you should be using either a stocks and shares ISA or a pension. Using these vehicles, we don't pay any capital gains tax or dividend tax anyway. So by using these types of account, you're avoiding that tax and never have to worry about it. But let me tell you where this could be more problematic, and that is looking at other type of investments that can't be held in an ISA or a SIP. So maybe crypto, maybe a rental property. If you now sell those assets I just mentioned, you now have a much lower CGT allowance, so you're much more likely to pay tax if you make a gain. Particularly for properties, rental properties, where you could make tens or hundreds of thousands, you're now going to be paying a bit more tax on that because the CGT allowance is going to be cut in half. From a dividend side of things, is also a bit of a nightmare. People often pay themselves dividends from their own company or businesses, me included, so £2,000 really isn't that much anyway that's tax free. It used to be £5,000, I think. Now it's being cut in half and half again. Once again, is going to mean the tax bill of people paying themselves dividends from a side business or a side hustle is going to be higher. And of course, yeah, we already pay enough taxes through everything else: income tax, national insurance tax, student loan, which is essentially a tax, blah, blah, blah. The fact our tax bill is going to be even higher now, of course, isn't ideal. And we could also talk about where the money actually gets used. Is the country better off now than 10 years ago? I mean, who knows? We can chat about that in the comments. Is the tax actually even being spent well? That's a big debate, of course. This is obviously a bit of a late video, as we only have 2 months until these cuts in allowances start happening. But if you can utilize these allowances now whilst they're higher, definitely do so. For me personally, I'm going to be paying myself £2,000 at least from my business, Making Money Simple, and it's a no-brainer because that allowance is going to get cut in half from April the 6th onwards. So if you also are maybe thinking about paying, you know, £1,000 in dividends, £1,500 in dividends, I'd say use the full £2,000 allowance now, just because from April the 6th onwards, your tax bill is going to go up because the allowance is going to go down. And yeah, that's the changes to capital gains tax and dividends, and that's one side of things. The other side of things now, which probably warrants more discussion, is this ISA cap. I got a response on Twitter from someone asking me about this. I said I'd make a video. I then watched Damien's video on it to get a bit more information. I also looked at some articles, so I thought I'd briefly share my thoughts. There's also a lot of videos out there. I'm a bit sort of late jumping on this. Could have got loads more views probably if I made this a month or two ago, but I'm still going to share my views on it anyway in case you don't know what I'm talking about. So there's a think tank paper in January that suggested to limit the amount you can hold tax-free in an ISA at £100,000. So the first thing to mention here is it doesn't actually specify which ISA. There's obviously 4 types of ISAs: cash, stocks and shares, lifetime, innovative. I assume it's just going to be all of them together. Doesn't really specify. But of course, as we mainly talk about investing, let's just focus on the stocks and shares ISA for now. Of course, this would impact long-term investors massively. Generally speaking, if you want to live off of your investments, you're going to need probably £300,000 plus, realistically probably £500,000 plus. Realistically, by the time we actually get to retirement with current high levels of inflation, if they keep up, maybe £1 million plus to live off of comfortably and not have to go back to work when you're 75 and have run out of money. So even though 100k is a lot of money, if you're going to be investing for the long term and then living off of that money, it's really not that much. If it gets capped at 100, that then means, of course, any money sort of over that, which just say you retire with a £500,000 portfolio, £400,000 would be liable to capital gains tax, which varies between 10 and 20%. Once again, in the sort of general gist of things, as the last points I was making over CGT allowances and dividend allowances, that just means your tax bill is going to go up, less money in your pocket and then more money to the government to use whatever they use it for. So let's obviously not get it wrong. 100k is life-changing money for most people, well, pretty much everyone, unless you're like a millionaire or billionaire. It's life-changing money. But when we're talking about investing, you know, for 20, 30, 40, 50 years, in the grand scheme of things, we should hopefully all pass that and get well surpassed that. So we don't then want to be building this tax-free wealth and then eventually have to pay tax on it, because what's the point in investing it now if we're going to get hit with a massive tax bill further down the line?
Now that's a lot of damage!
I think ultimately with this, and it's worth saying, this is only, I think this is the point that Damien made, it's only a think tank, it's not like official government stuff. Hopefully it doesn't happen, we don't know. But ultimately, they're really coming for the wrong people. If you want to get more taxes from people, focus on the ultra rich, the ultra wealthy, the billionaires, the corporations, because ultimately those are the people that are using offshore accounts, you know, using all these complex tax arrangements to avoid paying tax. It's better targeting those people than targeting people like us. Essentially, they're targeting the middle and working classes who work a job, invest monthly and religiously over decades, and then one day want to live off of that money to almost reap the hard work they've sort of built. By capping this at 100k, it's going to just put more taxes on people and it's going to make retirement more uncomfortable for most people. So I really think with this sort of suggestion, they're targeting the wrong people. I doubt billionaires even use ISAs because they probably have billions and millions, whatever, in offshore accounts, in tax havens, with a whole tax team set up to avoid all taxes. Yeah, I just think this is targeting the wrong people. It's also worth saying, as I mentioned at the start, what ISA are they referring to? Because in a stocks and shares ISA, over the long term, 100k is a lot of money, of course, but over the long term, we need a lot more than that to live off of. A cash ISA though, if you have 100k in a cash ISA now, not only is that probably bad, because I think with a cash ISA you maybe get a couple of percent and that money will be getting eroded due to inflation. If you have 100k in a cash ISA, that is a lot of money and you probably are very, very wealthy if you have 100k plus in a cash ISA. So maybe from a cash ISA perspective, it might make sense to maybe have some sort of a limit. Yeah, you're probably very wealthy at that point. From a sort of stocks and shares and lifetime ISA perspective, where you're investing for the long term, for retirement, to one day live off of that money, then as we mentioned, 100k really isn't all that much. One thing that's worth saying, so this is talking about capping the sort of overall tax-free amount of 100k. It is worth saying that the ISA allowance, or £20,000 per year, is very generous. I'm now living in Australia and there's no stocks and shares ISA equivalent. In America, they have the Roth IRA, which is a bit similar, but the allowance is $6,000. So what's that, about £5,000? So the £20,000 ISA allowance is very generous and it's brilliant compared to literally every other country. It's probably the best sort of tax-free allowance in the world when it comes to building your wealth and then living off of that money. So I'd say if you want to come for ISAs, I mean, I hope they don't get me wrong, but if you come for ISAs, the way to do it probably is to reduce that allowance maybe to £15,000, £10,000, or whatever it is, and then you force people into pensions or general investment accounts, which of course on both of those you do pay tax. Pensions, you pay it down the line. With general investment accounts, there's no sort of tax-free treatment, so you will pay tax eventually. I mean, maybe cutting the allowance is the way to go rather than capping the overall ISA pot, because they're focusing on the wrong people and it's going to really negatively impact the people like me and you, regular people who are investing every month and trying to build up our pot to one day become financially independent. And I think ultimately it's probably, if they, I don't think this will come in, hopefully it doesn't. If they did come in at people who are really sort of the savers, the investors who do it religiously every month, because obviously if you spend your money every month, then you're not going to have to worry about any future sort of tax to pay. Coming for the people who save and invest every month, so then get hit with another tax bill isn't ideal. I know I've said that a few times, probably sound like a broken record by now, but that is my thought. Yeah, this ISA situation, this was pretty much off the cuff. I had a few sort of bullet points here, but yeah, let me know what you think in the comments below. I'll be interested to hear your thoughts. I know there's already quite a few videos on this, but that wraps up this video now on both the allowances being cut and also the ISA being limited to 100k, and ultimately why the UK government hates us UK investors. If you agree with that or not, let me know in the comments. They do love us in terms of the ISA allowance, which is 20k every year, and hopefully that doesn't get cut, but they're now hating us in terms of the cuts to capital gains allowances and dividend allowances. And if this 100k ISA cap comes in, that'd be pretty brutal, and I don't think it'll go down well with normal everyday people. Thank you very much for watching. Subscribe so you don't miss any more videos, and I'll see you in the next one.